Inflation print out this morning. Will it be hotter than expected or will it cool as expected? And what does that mean for the markets? That's coming up on 3 Minutes on Markets and Money. So over the last couple of days, the markets have really rallied up into resistance and really just have been, as we've discussed, just kind of consolidating at previous resistance levels, really. And now the whole focus has been waiting, right, on this inflation print. This morning at 7:30, CPI will come out. Expectations are for about a 0.2 to 0.4% increase, depending on what source you're looking at. But that is expected to lower the inflation rate to 8.7%. Now, the expectations for the market is that weaker inflation, well, that'll be good for stocks because maybe that'll mean the Fed will slow their aggressive rate hiking campaign. A hotter than expected number, not good for stocks, obviously, because the Fed will be more aggressive in terms of the rate hikes. Regardless of the outcome today, we could see stocks move up. But if we go to our chart and take a look at what we've been talking about here lately, markets are very overbought here on a short-term basis. Again, we've pushed up into these resistance levels that we saw previously back in late May and early June. That continues to be good, solid resistance for the market over the last week. We've been unable to really kind of push above that level. Importantly, our short-term buy signal has now transitioned into a sell signal, but our longer-term MACD indicator, which is really the much more important indicator for our analysis, is still on a buy signal, but is beginning to weaken. We are starting to see that differential between the two indicators narrow. That suggests that price momentum is slowing. But again, with markets overbought here, there's not a lot of upside potential. So even if we get a very good inflationary number this morning, we could see stocks pop higher this morning. The question will be, what will that transition into over the course of the next few days? Again, with markets still overbought here, there's not a lot of upside potential. There is more risk to the downside. Importantly, though, a correction back to the 50-day moving average, where now the 20 has crossed above the 50-day moving average. That's a great level of support for the markets. Markets need to hold that level. So a pullback here that works off some of this overbought condition will certainly provide a better opportunity to put capital to work here short term than even today. But again, we need a bit of a correction here. We'll see what the inflation number looks like today, how that impacts the markets. We'll revisit this analysis tomorrow and determine what we need to do next. But again, while expectations are that a weaker inflationary print will keep the Fed from being more aggressive, it also doesn't mean, even at 8.7%, remember, we were all worried at 8.7% just a couple of months ago that the Fed was going to have to continue to be very aggressive to combat that number. So just the fact that we're coming back down to 8.7%, expectations are the Fed's going to somehow magically stop hiking rates. That's really not likely in the cards. And more importantly, there's certainly no indication that the Fed is going to start reversing policy, going back to quantitative easing anytime soon. And that was your real driver for markets over the last 12 years. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow and see what inflation does, and we'll talk about the markets then.